Yeah, we'll be fine when we start talking. So one of the things that I just learned was about you being pregnant. So again, congratulations. Have you found out? Do you know, boy, girl?
Not yet. We're going to take the test this Friday, and then it takes about a week or two to get the results. But I'm really excited. Oh, it does look like we are now live.
Are we live? All right.
Yes.
Fantastic. So it looks like there's a few people here in the waiting room. So before we officially start here, I'll give a minute to allow everybody to kind of come in here. Okay. For those of you that are in, our weekly community cafe is something we do every week. We started this a few months back, and something I'm look forward to now each week. It's kind of fun to do this. This is our first week having Angela Hudson on as a guest. So Angela is a financial advisor with Affinity Asset Management, and she is also volunteers with the Foundation for Financial Education, where she lends her expertise on financial planning and tax strategy planning to people through a nonprofit business. We have her today joining us with our cafe, and we're going to talk about one of the tax strategy planning, tax planning techniques that can be used by a lot of people, but a lot of people don't understand it and don't use it. I think a lot of advisors don't fully understand the benefits that can come from this. So we're going to tap into Angela's expertise on this, and we're going to be talking about Roth conversions as a tax strategy. So there's a lot of people that I run into when I'm doing appointments, and Angela, I don't know if this is true for you, but I run into a lot of people who really don't understand what Roths are. They've heard the term. It's rare that I meet someone who hasn't heard of a Roth. They'll say, yeah, I heard of it, but I really don't understand what it is, and they don't know if they've had one often or not. So if you could talk a little bit about what's the difference between a traditional IRA and a Roth IRA, and what's the importance or significance of that difference?
Oh, I sure can. And hello, everyone. Thank you for joining here today. I do have a visual to help kind of explain this a little deeper. And we reference this, you might have seen it before. It's called the 3 tax buckets is what we call it. A lot of people have the bulk of their assets here in the IRA. Tax deferred bucket, whether it's 401ks through their work, whether it's pensions. A lot of people obviously have Social Security as well. The benefit of an IRA or 401k, those tax deferred accounts, is you get a tax deduction when you add those funds within it. So a lot of people like that thought to have the taxes deducted, but aren't aware as that account gets bigger and bigger and bigger, that snowball of taxes is getting larger and larger and larger in the background as well. Downfall, you do have 59.5 rules, cannot touch your money until age 59.5 without a 10% penalty in addition to taxes. But the bigger rule is 72. It was just increased from 70.5 to 72. Though with coronavirus, you can skip that rule this year only. And I'll talk a little bit more about that, but it is called required minimum distribution.
And Angela, when you say 72, we're talking about when you turn age 72.
That's right, yes.
Now that triggers that you have to start taking distributions.
Yeah.
That is one of the things that people, they, as you said, they're putting it in. They like that tax deferral, right? They're putting it in, and the contributions are being deducted from their income. They're not paying taxes on that portion. But, as you said, that all they're doing is deferring those taxes. They're not avoiding taxes. They're deferring taxes to a later time.
That is right. And and a lot of people, now there's caveats to that. 401ks, when you're getting an employer match, you want to utilize that employer match because that's free money. So you want to at least maximize that. But having the awareness that you turn age 72, the IRS's mindset behind that is everybody's going to pass away at some point. So at age 72, the IRS wants to start collecting some of those taxes. So it's required minimum distribution, the minimum amount you are required by federal law to distribute or withdraw every single year for the rest of your life. It's an ever increasing formula as well. And I'll talk a little bit deeper about that here in a moment. But that's the general sense of the tax deferred bucket. You add your money into it, you get a tax deduction, but it continues to compound tax deferred, which you have to address that liability later. Next, we've got the taxable bucket, tax now. This is with after tax money. You get it into those accounts. It does not have any kind of 59.5 rules or 72. The downfall of it, as it grows each and every year, they generate a 1099 and you pay taxes on the growth year by year by year at a lower rate. Typically it's long-term capital gains, which is a maximum of maybe 10 to 15%. So it is a lower rate, but you are paying those taxes every single year. So that's our second favorite bucket. What's the little known bucket would be the last bucket, tax-free. And that's what I want to visit heavily about today, specifically Roths. Roths are not an investment. IRAs are not an investment. Non-IRAs are not an investment. They're tax codes. It's simply how your growth on your investments will be taxed. Roth IRAs, they've been around since 1997, but who teaches you about them? Financial advisors are more of investment advisors and focus on investments. Your CPAs, they're focused on saving you income taxes that year. So who educates you about them? And that's why we haven't seen very many people in Roth IRAs, but they are the only source that can grow tax-free. You put your after-tax money into it, it grows tax-free for the rest of your life. It grows tax-free, it's inherited tax-free, you withdraw it tax-free, and there are no minimum distributions because you don't owe taxes on that. So that's what I want to visit heavily about, so we can start seeing people educated about Roth IRAs, able to shift some of their money into them, because that will have just a compound effect on them later in life of benefiting from taxes. Does that make sense the way I kind of worded that?
Yeah, it does. And I'm a visual person, so I think having the buckets helps you. Here's how I envision, and we'll explain this sometimes to people, is with your traditional IRA, your 401ks, 403bs, your traditional retirement accounts where you're deferring taxes. On those, think that you put your money in and you don't see Uncle Sam. But at age 72, for some of you, they're already over that. You kicked in at 70 and a half, but the new rule is 72. At age 72, you have to start taking money out, whether you like it or not. You're on the government plan. And Uncle Sam is standing at the back door of your traditional IRAs and 401ks with his hands out, and you got to pay Uncle Sam as you take it out, and it is income to you. Whereas with the Roth, Uncle Sam's standing at the front door. We still have to see Uncle Sam, but we pay our taxes, give him the money before we put it in to the IRA. But now, as you said, everything inside of that Roth grows tax-free for the rest of our lives. We're not now, there is no government plan. We're not required to take it out because they've already got their tax money on it. And for the estate planning part of things, I tell people, when you pass this money on to your kids, they inherit it tax-free. When they inherit your traditional IRAs and 401ks that's never been taxed, you didn't get, Uncle Sam didn't get paid during your lifetime, they now are forced to take it out under the new rules within 10 years, and they will pay taxes at their tax rates. And Uncle Sam's going to want money, and they may be in their working years, so they may be in higher tax brackets than you're in. So with a Roth, you paid the taxes, they inherit it tax-free, and they get an additional 10 years of tax-free growth. So yeah, I'm with you, Andrew. It's just a fantastic investment that too few people take advantage of as well. And so no required minimum distributions. So talk about these required minimum distributions that kick in on your traditional IRAs and 401ks. If you would talk a little bit about why does that matter from a tax standpoint? How does that affect people when they're required to take this money out, whether they need it or not?
Okay, yeah. A lot of people have the mindset that they're going to maybe have a lower lifestyle or a lower bracket in retirement, but that's very often that we don't see people downgrade their lifestyle, especially when they have Social Security, pensions, and distributions from their IRAs that they don't plan for. That's going to naturally increase their tax bracket. So that awareness that your tax brackets do increase. So required minimum distribution, for short, we call it RMD. It starts at age 72. And let's say by 72, it is $50,000. It's typically around 4% of your portfolio, but it doesn't stay at that same percentage. By 82, 10 years later, it will double to $100,000. And by 92, 10 years later, it triples to 150. So it's an ever increasing formula.
And when you're talking 50, 100, 150, you're talking about the amount of distribution that they have to take out, because the percentage goes up of what you have to take out.
Yes, it continues to increase throughout the rest of your life. So ideally, and before I kind of move on, if you forget to take out your required minimum distribution, the penalty is 50%. So you just lost $25,000 in this example, and just a penalty, and it's every single year for the rest of your life. So ideally, if you can start sooner, let's say, for example, age 60. So you're past the 59.5 rules, you have more options of how to handle the taxes. Start Roth conversions so that you transfer your investments from the IRA into the Roth, kind of bite the bullet of taxes now while they're still low. With the largest stimulus bills in history, it's only natural tax brackets will need to continue to increase. So slowly transition those IRA monies into Roths so that you can flatten this curve over time and not expect that to increase. So over time in your elder years, you're saving this type of difference. I've seen over and over and over people saving hundreds of thousands, even millions in just taxes, depending on what age they are, their life expectancy, where they sit in their bracket. So it does greatly help people. And like I mentioned, this isn't an investment. This is a tax code. So having a tax strategy in advance will help you in your later years in life when you have more domino effects. Your Medicare premiums, those are based off your taxable income, not your health, not your life expectancy, what age you are after age 65. It's based off your tax bracket and what your taxable income is. Social Security, it's taxed one of three ways as well. It could be tax-free, it could be taxed 50% of your paycheck from Social Security, or 85% of it. That is also determined by where you sit in that tax bracket and what your taxable income is. So your Medicare premiums are increasing, your Social Security paychecks are decreasing, your pension, they can decrease as well because now you've got more of the IRS eating into those dollars. So it has a domino effect in later years.
Yeah, absolutely. People don't realize that, hey, when I'm taking these distributions out of the IRAs or 401ks, that is income in the year that the distribution is taken. And you have to take it. And now, because you've got more income, it moves you into higher tax brackets, and it affects your Social Security is now taxed, your Medicare premiums or surcharges go up. And those are just things that people get blindsided by because nobody's talked to them about that. Nobody, explained to them the tax impact of this stuff. And, we're in historically low tax environment when it comes to income taxes, right? As I tell people all the time, we get taxed every other way to Sunday with high property taxes, high sales tax, but income taxes are low. And as you said, Angela, as we look forward, it's hard to imagine that the income taxes are not going up with the deficit spending that government's doing right now. The fact that we're in historical lows, I think we can all pretty much agree that they're probably going to go up, certainly going up before they come down. And so can we take advantage of that to do that? So let's talk about how money gets into a Roth, because something else I hear commonly, people say, oh, I'm not eligible to put money in a Roth because I make too much money. And
I hear that often as well.
There's other ways to get it in. So explain that to us.
There sure is. So there's a couple different ways to add money into a Roth IRA. If it's an individual Roth IRA, there are contributions. So bank money added into the Roth, but you are right. There's income limits. For a married couple, it's around $200,000. So if you make over $200,000, you guys cannot do contributions. The caveat to that is if you have a Roth 401k with your employer, there's higher income limits. You can add more into it, which I highly recommend. if not for you, your children, educate them about this of add their contribution to the Roth 401k, and the employer match will continue to go into the deferred because they want their tax deduction. But that's ways to get tax-free money growing. But if it's a traditional or Roth in your name, there is income limits. But that's small money, each and every year, smaller amount of money. The limit, if you don't make $200,000, is $7,000 per person. If you're over the age of 50, if you are younger than 50, it is $6,000 per year. Now let me change the mindset, because a second way to get money into a Roth is called a conversion. I'm going to convert my IRA slowly into a Roth IRA. But to be able to do that, you don't even have to sell your investments, but we do have the IRS to address, taxes. And then you transfer it to the Roth. I'd rather see people calculate how much taxes does $7,000 cover in a conversion. Maybe you do $45,000 and that triggers $7,000 in taxes. Instead of just $7,000 as a contribution going into the Roth, you get $45,000 into the Roth in that example, costing the same amount of money out of your pocket.
Because there's no limits to how much you can convert, right? You can convert, 5 million. If you had a $5 million IRA and wanted to convert it all, you could. And obviously you would probably not want to do that. And why would that be? You might not want to convert it all, even though you could.
That's right. Now, there is no limit to how much you can convert into your Roth, but then again, you got to be sensitive to those tax brackets. And the closer you get to age 72, the more time sensitive that gets, because you cannot convert your required minimum distribution. And what I mean by that is, if your required minimum distribution is $50,000, you have to take out that money and put it into this middle tax bucket money. Bank accounts, non-IRAs. So you cannot convert that amount. You have to convert a higher amount on top of that to be able to get into a Roth conversion. So it makes it more time sensitive. But I don't want to see you jumping into much higher tax brackets than what you would have. It's kind of a delicate dance of where do you sit in your tax bracket? How much wiggle room do you have into the next bracket without pushing you into it too terribly much? Life expectancy has a role to play as well. The Medicare premium brackets have a role as well. So typically rely on financial plan software to calculate how much to do each year, how to handle the taxes, and when to stop. Because when you do a conversion, there are two ways you can address the taxes it triggers. One way is the least advantageous, but it's to withhold the taxes from the conversion. So say you take out $30,000, $5,000 or so goes to the IRS, and then only $25,000 hits the Roth IRA. That means your investments are taking a step back, that they have to accumulate back before it really benefits you with that tax-free growth in addition to that 30. But it's doable if someone doesn't have bank money to cover those taxes, money market, CDs, even non-IRAs, because that's the most advantageous way to cover the taxes. Is if you have some liquid money in the middle tax bucket, take out $30,000, convert the entire $30,000, and now you have $30,000 in your Roth IRA, a higher amount of money, because you want the most amount of money to hit that Roth, because that's the part of your portfolio that's growing tax-free.
For the rest of your life, and can go on for an additional 10 years of tax-free growth after your death, passing your kids. Yeah. And Angela, it gives options. This is something I talk to people too, is that when you have Roth, if you need additional money in retirement, everything you take out of your traditional IRAs and 401ks, it's taxable to you. And sometimes you may have an expense. And so you could reach into your Roth and take it, and it's not income to you. You've already paid taxes, so it's not going to affect your Social Security and Medicare. So it gives you options during your lifetime. You're getting that tax-free growth. Let's talk about this. This is something that I think a lot of people miss, is sometimes there can be some timing issues of when you convert. So you mentioned the timing. You want to do it when we're in lower tax brackets is good. So just our tax environment just in general is low. Certainly if you're already retired and you're not yet 72, or even if you are 72, but below age 72 and retired because your income's already lower, that would be good. But talk a little bit about when the market is down. So if we have market drops, that can be a great time to do the conversion. So maybe talk a little bit about why that is.
That's right. Like earlier this year, market dropped about 35% in the course of 5 weeks, which is not fun, but that was temporary. So while your IRAs are down, it's going to be a temporary point in time, and converting those IRAs while they're down into Roths so that when they recapture back to normal, all of that growth from trough to peak is tax-free. Now, something you mentioned, even when you are working, time itself has a value. You want the Roth IRAs to be established for as long as possible. So even if you're in those higher tax brackets, Roth conversions are still advantageous. You just do smaller amounts, little by little. And then when you retire and you have that drop in income, then you're going to be more aggressive. But don't mix the idea altogether when you're still working, because time itself has a value. And if I take a moment to kind of visit about the efficiency of the growth and what I mean there. Like I mentioned, Roth IRAs are not an investment. They're a tax code, just like an IRA. So let's say you have the investment Apple stock. Everybody's very familiar with Apple. You've got Apple stock in your IRA, and you've got Apple stock in your Roth IRA. And Apple stock itself does 10%, let's say. So 10% over here, 10% over here. But at the end of the day, this 10% in the IRA, when you withdraw it and it's in your hand, it's not a net 10%, is it? After the IRS gets a hold of you, it might be 7-8%, depending on what your tax bracket is. So that's not a full 10% in your hand. Your Apple investments or stocks over here, that 10% is a net 10% in your hand because the IRS doesn't get a piece of that. So the efficiency of the growth and that awareness as well, to kind of view it that way as well. So not only just taxes over time with conversions, the growth of it, you don't have to calculate the taxes before you get your portion. And yes, when you need to take a very large withdrawal, whether it's a new vehicle, the foundation's kind of acting up, or an air conditioner, whatever it may be, and you need to take a large chunk and you're worried about your Medicare premiums, your tax brackets, that's going to be another reason to utilize those Roth IRAs. So you don't have to worry about the domino effect that taxes can have.
Yeah, and I think people get confused a bit of what it is, but you said, it's the IRA, these rules, IRS rules are just a tax code, a tax blanket that apply, and we can apply it in the bucket. So you think, okay, the IRS code section, IRA, we can throw it over any investment. So it could be a CD, your bank account, a mutual fund, Apple stock, real estate. I mean, it can be, any investment can be designated as an IRA. You're just saying in a traditional IRA, I want any contributions I make or growth on this to be tax deferred. And in the Roth, you're saying, I want this, I'll pay my taxes before I put it in, give the money to Sam, and I'm applying that IRA tax code to this. So again, a lot of people don't understand that how it doesn't affect the investment. Investment can be same.
No.
The other thing that you and I see all the time is that for so many people, the bulk of their money is in IRAs, right? And so getting out, as you said, early and starting to at least have your eyes open and know what your strategy is with tax strategy. And, because it's definitely has an impact, not only on your kids when they inherit it, it has an impact on you in retirement. The idea is we want to make sure that your money gets you through retirement, gets the end game. And if we can minimize the impact of taxes on our portfolio, it can be huge. You know, our two biggest threats for people, and we've talked about this before, taxes and long-term care, right? Those are two threats for most of us as we start nearing or get into retirement. And we can have a plan and need to have a plan for both. So having a tax strategy plan is important. Angela, you know, one of the things that I have just noticed over the years that, you know, clients will have CPAs and their CPAs aren't talking to them. They're not giving them tax advice. People have financial advisors. They're not talking about this stuff. In your opinion, why is that, you know, they're not talking about?
Oh, I get this question all of the time. And even Mark Roberts, who you typically see during these community cafes, he's who taught me. I've been here over 7 years. And if you think of the mindset of a CPA, they're focused on this year saving you the most amount of taxes, maybe next year and how to avoid taxes. They're not talking about the rest of your life. And then what a Roth conversion does is it triggers you taxes today so that you can save taxes on the rest of your life. It's a mindset. Some CPAs are knowledgeable about them and recommend them. Some of them, they don't, because they're so focused on this year and not the rest of your life. Advisors, there's a difference between an investment advisor and a financial advisor. An investment advisor is just going to be talking about investments, maybe how long they'll last. A financial advisor is what's going to be talking about these strategies. We actually host workshops with Mark Roberts who teach financial advisors how to do these and why. And we do see the baby boomers having just the lion's share of their money in tax deferred assets, which everyone watching here today, write down the words Secure Act. That was a new law that was passed as of this year, that when you pass away, if you would have passed away last year, your beneficiaries would have had the rest of their lives to stretch those taxes over. So little by little, bite-sized pieces each year. Not anymore. With the Secure Act in place, your beneficiaries have 10 years to pay every penny in taxes on everything that they inherited from you. Now, they can do it all in the first year, all in the last year, a tenth, a tenth, a tenth, a tenth. It doesn't matter how, but within 10 years at that due date, you better pay every single penny in taxes, or there is a 50% penalty they will be paying. Oops, penalty.
Right. So for those who have inherited IRAs that they have inherited, right, it's important to have a tax strategy for you as well. In fact, you know, every bit as important is for, you know, your own money that you have in your own IRAs and 401.
Domino effects on not only you, but your beneficiaries and how that impacts their lives. I'm sure you've seen that side of it as well, of not only the taxes part of it, but it can cause some friction between. So having a nice pre-planned estate plan in place as well helps cause that to avoid that friction. All too often, we've seen family members not talking anymore for years and years because of this friction. So having a good strategy in place, not only for your portfolio, but your estate, is crucial for the health of your family as well.
Yeah, I mean, and just tax strategies in general, minimizing the impact of taxes while you're alive, minimizing those taxes that we pass on to our kids. A lot of it's about education and just making sure that we apply the appropriate strategy. And there's so many things that can be done that people miss out on. You know, if we're going to leave to charities, and we want that money to come from those traditional IRAs, they're tax exempt organizations. They get every dollar, but our kids, when they inherit the IRAs, they don't. So little things like that, even while we're alive, you know, where we're contributing money, how we contribute the money to charities, all of those things matter. Angela, we're coming up close on our time.
Okay.
This is something that's so important that, you know, the vast majority of listeners are going to be able to apply this strategy. So if they say, hey, Angela, I need to know more about this, what do? They can reach out to you or Affinity Asset Management, to your firm, and no cost, you can kind of run them through something and see how this might apply in their situation.
That's right. Yeah. So kind of a recap of what we visited about Roth IRAs: 4 things: tax-free growth, tax-free withdrawals, inherited tax-free, and it avoids required minimum distribution at 72.
Yeah, they are fantastic investment, a tax code, a way to save your taxes, and conversions are the way to go for those who have large amounts in their
And
IRA.
to learn more about them, just give us a call. Like he mentioned, we have a not-for-profit. It's called the Foundation of Financial Education. We can run those conversations through the not-for-profit. We will not charge for that education, as it's what we're here for. We want to help. Typically start off with a phone call to get to know each other, give you that guidance. But yes, just give our company a call, and we can most definitely help people with that.
All right, awesome. I want to introduce next week's topic. So next week on Community Cafe, so same time, same place here, we'll go on. Mark Roberts is going to be presenting, and he's going to talk about how to maximize your Social Security benefits. And there's another one that people don't understand. They get blindsided. They just walk into the Social Security office and apply for their benefits. And there's lots of different ways that you can apply. There's timing issues of when you apply. So Mark Roberts is going to be talking and teaching us about how to maximize our Social Security benefit. So I hope you tune in. If you have anybody who's nearing that age of retirement that's coming up on it, I would highly, highly encourage them to tune in next week. And if they can't make the time, there's always the ability to go on and see this on a replay by going to either Affinity's website. I think you guys post it there. I know we post on our website, so they can always see the replay. But please tune in on that stuff. It's going to be a fantastic program next week. So Angela, unless you got any parting comments, I think we are out of time here.
No, I did. Thank you for listening here today. I know it got a little nerdy real quickly, but thanks again for your time. And I look forward to seeing you next week.
All right, Angela. Take care. Everybody have a great rest of your day and week. Bye-bye.
Thank you.